Anybody who knows me personally is probably tired of hearing me talk about USA Truck, but I've never done a video on them, so I want to do one. This is probably my favorite company. I've been on this stock for a long time. It's actually not going to hit all the normal benchmarks that I set for stocks. Like, it would probably fail the 8-pillar analysis if you're an Everything Money fan too, but it's one of my favorites. I think it's a chance to buy a great company that's growing, that has outstanding management, and most importantly, get it at a good price, or even better, a discount. So before I start, let me tell you my story that's going to contain some disclaimers in it, okay? I work in the chemical manufacturing industry. I work in manufacturing department, but I talked to the logistics group and everything, and like a little ways after COVID, late 2020, early 2021, they were talking about all these trucking prices, that all the trucking companies were making so much money, they were charging out the wazoo. So what did I do? Naturally, I went and looked up every single public trucking, logistics, shipping company I could find. I have a notebook somewhere that's just got like hundreds of stocks and notes on them and they're just trucking and logistics companies. I think I narrowed it down to like 5 companies, and then finally 2. The 2 were this one, USAK, and then ArcBest, which is ARCB. And then as I learned more about USA Truck, I just really like that one. Nothing against ArcB. Of course, the disclaimer is that this is my largest position, okay? I have a significant portion of my portfolio in this stock. So I'm probably going to be showing this company in an optimistic light. I'm trying to be unbiased, but it's human nature. You can't help it. So keep that in mind, all right? But I want to show you what I like about the company, and maybe you can use this to learn about other investments. Because like I said, not everything has to pass all your benchmark tests or your pillars, all right? Especially if you have an insider edge in the industry. Not insider, I didn't say that word. If you have an edge in the industry because you work in it and you can know general trends and stuff or be on the front line. All right, anyway, let's go through the price history real quick because this is pretty interesting. I actually didn't think I was ever going to be able to do this video because I don't like to do a video on a stock that I own if the price isn't lower than the highest amount I've paid for it. Okay, so I've paid as little as $11 a share for some of my shares and as high as $21 a share. So today, whenever it went under 21, I said, okay, this is it. I'm finally going to be able to do my USAK video. All right, so the last month has been rough. It's not been fun. Minus 33%. And before that, let me see, if I go to 3 months, yeah, the last time I bought was like after their Q4 earnings. I mean, they blew it out the water, and I thought it was at a discount at like $19 a share, so I bought some more at 19, and it went up, and I was all happy, and then we're way back down below where I bought. Anyway, I don't think anything's fundamentally changed. I'm going to show you what I mean as we go through the financial statements. Real quick, though, this is what spooked a couple people about the trend of the stock, okay? They see this trend. This is a 10-year chart, all right, 10 years. They see, okay, trucking company is cyclical, and that's where my quote up top is about cyclical companies. And it's obviously cyclical. We're going to see that in the income statement as well. So look at this. It looks like, we go up, we come down, we're up, and then we're coming back down. So everybody doesn't want to get caught holding the bag the next time it goes down. But the people who are saying that are probably the same exact people who were saying the same thing here. They were saying, oh man, it's going back down. They said it again here. And then finally they're saying it again. All that being said, I'm not trying to be a technical trader here, which is, reading the charts and patterns and trying to figure out which way that's going to go. I put that up with like astrology. But what I will say is that I really think that this company, the more I've looked into them, they're really prepped well for the downturn, and they've kind of added a new business segment that's going to, I think, carry them through that. And I would be surprised if we saw some of the negative earnings on a consistent basis that led to these two pits, if you will. All right, that's it. Let's go into some of the stocks, some of the fundamentals. First thing I want to look at, I don't really show this often, but it's insider ownership. So this is important to me. It's not a must, but it's really important for a company. So let me show you this. This is Yahoo Finance. Real quick, look, all these shipping companies got beat down today. Look at this. Pam minus 14, Martin minus 5, Werner minus 7. Wow, Knight minus 6. Okay, anyway, Yahoo Finance, I go here to holders. Then I want to look for percent of shares held by all insiders, and it's right here. You can see 19%, 18.98% held by all insiders, all right? That's a lot. The people who are running the business control about 20% of the company. What's good about insider ownership? Well, there's 2 things that are good. The first one is obvious, right? If the people who are running the business own a lot of shares, that usually tells you that they think that it's a good investment, right? Or else why would they own shares with their own money? Secondly, is that whenever management owns a lot of shares of a company, that really helps align their best interests to the shareholders' best interests, right? Because the more the shareholders make money, the more they're going to make money. So it's good to be in a company with a lot of insider ownership because you're usually getting looked out for as a shareholder, right? Okay, so let's see. If I go to insider roster, it'll tell me all their board or all the directors and their officers and how much they hold. Look at this. This is their CEO, James Reed, owns 312,000 shares as of February 24th, 2022. So look at this, 312, 121. So if I multiply that by the current share price, which is what, $18, he owns over $5 million in stock. That's crazy. So this guy's really betting on this company, and he's the one running it. And one thing here, whenever I talked about they have outstanding management, he came on as CEO in the beginning of 2017, and I think he's done a great job. So we're going to see that as we go through the financial statements. All right, let's start with the income statement. First up, total revenue. So this is every quarter going back to March 2005. So we go back a long ways, like 17 years. Look at this. This is that cyclical nature we talked about, right? It's just up and down and up and down and up. So people think it's coming down, right? One thing that's really interesting here is that USAK is not just a trucking company, all right? Trucking company, that makes a lot of sense. I think people know what trucking companies do. You pay the trucking company to deliver something from point A to point B, right? Pretty easy. They also have a logistics segment. And the logistics segment works kind of like as a freight broker. They broker deals between two parties, right? One party who wants to ship something and then another party who has the means to ship it. And they make that deal happen, take a little bit of commission. There are a lot of companies that do that, but they were able to integrate that with their trucking company and really generate a lot of revenue and income from that. Let me go to margin because I want to talk about just the trucking business as a whole because let me see. Let me change this scale real quick. So I'm going to just come over here to 2010 before we start anything. All right. So this is their operating margin in percentage. And you can see this is actually pretty low for me, right? I usually like, way higher than this. And I mean, we're single digit margins. That's kind of sad. One thing about the trucking business is that it's not a great business. You have high initial capital costs with all your vehicles that depreciate really fast and require a lot of maintenance. It's expensive. On top of that, it's a super competitive industry, right? There are trucking companies everywhere, so the price for trucking is almost like a commodity. You don't really have control over that. But one thing that makes them different is that logistics company, that is actually a really good business because even though it's low margin, and will contribute to a low margin because they're just taking commission off of large trades. A plain logistics company that's mainly, brokering deals is not a high capital requirement, right? All you're really paying for is the people and the software. You're not having to buy equipment that's going to depreciate and just depreciate no matter if you're making money or not. I think that that's going to be a really solid piece for it moving forward, even though it won't show up on this margin. So that's kind of why the margin's low. And, some people would say this is a red flag, and this is one of the ones that I talk about that usually, I have a much higher benchmark for operating margin, but I'm okay with this. All right, so let's go to pre-tax income, and here you're really going to see the cyclical nature again. Let me put this back in dollars. Okay, yeah, look at this. It like mirrors that stock price, right? So the earnings go up, stock goes up, earnings go down, stock goes down. All right. How do I want to get a number here? Because I'm gonna use this to value the company. So let me be a little conservative here. I'm gonna take the average of, let's see, the last 7 quarters. I'm going to go all the way into the COVID year. All right, so the average of the last 7 quarters is $6.3 million a quarter in pre-tax income. So 6.3, that times 4 is $25 million a year in pre-tax income, okay? I'll write that down here, 25 million. Growth rate, let's see. The growth rate, I just said, right now their pre-tax income is about 6.3. Remember, what do I always say whenever you're evaluating a growth rate for a cyclical company? You always go what? Peak to peak. Don't go pit to peak. I say this every time. You're probably tired of hearing it. But we're going to go from about $5 million a quarter to 6.3, okay? In the last 5 years. So you see here like 2017 to 2021. Well, that's 4 years. But 2017 to 2022, that'd be 6.3 is what they're at now. They were at 5, yeah. So they went up 1.26 times in those 5 years. So I'd raise that to the 1/5. And I get a growth rate of 4.7%. All right, I subtract by 1 to get the actual growth rate, 4.7%. I would round up to 5% usually, but trying to be conservative, all right? And then lastly, let's look at earnings per share. Again, you can see the cyclical nature. I'm going to, just get, let's say the last six quarters. Yeah, the last 6 quarters, we had a Earnings per share average of 61 cents a quarter. So 61, 244. That's what I'm going to put for earnings per share, 2.44. All right, that's it for the income statement. Let's go to the balance sheet. First up is my pre-tax return on tangible assets. All right, y'all know I love this measure. It's an efficiency rating for the company almost. It's like how well are you using the assets that you have to make you money. I really like to see this over 10%, minimum. You see they're consistently under it, but recently they've been going over. I think that that's the consequence of having that other segment that's going to be generating more earnings on less capital, right? So that's good to see. Anyway, let's go to total equity, all right? Because this is what originally turned me on to this company, okay? As I was going through all those different trucking, shipping, logistics companies, it was actually really, really hard to find a company that had positive equity that wasn't upside down. I mean, there were some, but most of them were just so leveraged with debt, with leases and stuff, had such little assets that it was kind of gross. I was like, man, this business is terrible. This was like one of the only ones that I found that had like good equity at the time. Remember I said I found it at like $11 a share. So, at the time it was close to a PB of 1. I think right now it's a price to book of 1.4. So real quick, let me tell you a little bit more about this stock because like I said, I found it originally from the equity, but this thing's like an ogre. It's got layers, right? Or an onion. I found it first for the equity and I was like, okay, this is great. This is one of the only trucking companies with pretty decent price to book. Then I continued to look at it and I'm like, man, it's actually selling at a pretty good discount to its current earnings, which is pretty rare. So that's like another layer of goodness. And then finally I'm looking at them like, man, they just keep growing. They keep setting records. They've had 6 record quarters in a row, and their ambition, their targets for 2024 that we're going to go over at the end of the video would just be insane growth. So, it's just, like I said, like an onion or ogre. Okay, let's go. This is their total equity. One thing I want to show you here, and this is neat, because remember, the CEO started in the beginning of 2017, so right here. Look at the equity growth since he started. Pretty interesting. I'm going to go back to the income statement really fast. When was their downturn? It was 2019, in the beginning of 2020. Okay, that's whenever they were losing money or, on the lower income. If I look at their equity at that time, you can see right here, I mean, it didn't really take a big spike down, so that even though that they had a down year, they weren't really losing equity. And the reason, I think, is that they don't have a lot of debt, and we're going to see that in the debt to equity ratio, and they have pretty good cash flow. They kind of meet the criteria of the quote up top, right? So, I mean, it's just another good sign. Let's look at the debt to equity ratio real quick. Just show you that. See this? I say you usually don't like it above, I guess 2 to 2.5 is the textbook definition of good, but what's really important is the trend, and you can see here they're really, really driving that debt down or the equity up. Either way is good, right? It's debt divided by equity. So lowering debt will bring this down, or raising equity, your net worth, will also bring this up or down. So great. All right, what's last? Last is number of shares, all right? This is one thing that is a little bit frustrating. Not frustrating, but it's a minor red flag for me, okay? So we have had a little bit of dilution, not buybacks. That dilution doesn't bother me because that's just people getting paid for, stock compensations and stuff that are just issued new shares, I guess. I don't know for sure. What worries me a little bit is the lack of buybacks because, in my opinion, this is a stock that's selling for a massive discount. Management on their earnings calls have said that this is a stock that they think is selling at a big discount. I think it's ripe for share repurchases, okay? Now, what do I always say about share repurchases, right? There's really like 2 things that a company can do with money, right? They can keep it or they can give it to the shareholders. If they decide to give it to the shareholders, they can buy back shares or they can pay out dividends. I think buyback shares is usually the best option, especially if the stock's selling at a discount. Dividends, not so much. On the other hand, if they keep the money for themselves, which is what they've been doing because they're not buying back shares or paying dividends, they can use it in 3 ways in their own company, right? They can pay debt, they can buy other companies, or they can reinvest in themselves. Now, I don't really think they're in a big, heavy debt position, so I don't think they need to pay down more debt. I'm not sure they're looking to make any acquisitions, so I think that's out the window too. Reinvested in themselves, however, you're going to see, and I've already kind of teased this once, but whenever we get to 2024, they have some pretty ambitious growth goals that they want to achieve, and it's hard to achieve that without, keeping the money that you're making to help reinvest in your business. If that's their plan, that's a better use of the money than buying back shares because their growth is so ambitious, and they're actually on track for it. But the other thing that makes me a little bit more confident here is that Remember, the CEO has $5 million in shares, okay? He owns 300,000 shares. So that's just another benefit of that insider ownership. It makes you feel a little bit better that they are acting in what they believe is the best interest of the shareholder. Doesn't necessarily mean it is what's in the best interest of the shareholder, but at least they believe they're acting in the best interest of the shareholder, right? Some companies don't even do that. All right, I'm rambling. Let's go to the cash flow statement. All right, free cash flow. Look at this. All right, it looks kind of all over the place, but you're gonna gawk whenever you see the number, huh? So look, look at this. They had quarters recently where they were generating consistently between 10 and 15 million dollars a quarter in free cash flow. 13 times 4, that's $52 million a year. Think about that. That's like, what, a third of the market cap? So they would pay off the whole market cap in 3 years. That's crazy, huh? One thing here to keep in mind, though, is that this high cash was due in part to their inability to buy new trucks because of the chip shortage, okay? So because they couldn't buy new capital, you're going to see their capital expenditures were low for this time period, which meant their free cash flow was high, right? Because what's free cash flow? Free cash flow is your cash from operations minus your capital expenditures. And I'll show you that real quick. Let me just show you their capital expenditures. You can see here they went through a big period where they weren't buying anything. So they were generating a ton of cash. And you know what's funny is they were complaining at the time because they were like, this isn't good because we're going to have older vehicles and it's going to require more maintenance, but it really helped your free cash flow, huh? So they're going to start spending a little bit more, and I assume that the free cash flow is going to come back down to earth a little bit. Let me get a free cash flow number before I go to valuation. Obviously, I'm not going to use 52 million. That'd be a ridiculous valuation. That's how you lose money, making ridiculous optimistic assumptions, okay? So let's see. Let me go back. I'm going to go back like all the way to 2017, all right? So what is that, like 4 years? Okay, so I'm going to go all the way back here, and I get an average of $5.5 billion a quarter in free cash flow. So 5.5 times 4 is 22. All right, let's go to valuation. First up is my rule of thumb method. This one's super easy. It's just always my first check on stocks. I just take what I think the pre-tax income is, multiply by 10, and compare it to the market cap. So in this case, I divided by the number of shares. I divided by 8.9, which is the number of shares you can see in the top right of my screen. But you can really also just ratio that to the market cap. Okay, so I get $28 a share here. All right, next is this formula, earnings per share growth formula. So let's see, what was it? 244 times 8.5 plus 2 times 4.7. Yeah, that's ridiculous. 43. Wow. That's way too optimistic, I think. I don't want to go there yet. I think it's possible, but let me do this too, because I just want to be super optimistic. Let me take an even more conservative earnings per share. So let's see, I'm going to go all the way to the last, let's do this, the last 8 quarters. All right, so the last 8 quarters is 41 cents a share times 4 is $1.64. All right, that's much better. If I do $1.64 times, let's see, 8.5 plus 2 times your growth, which is 4.7. Yeah, still $29. All right. I mean, that's good. Let me change this earnings per share. What was it? $1? What? I even forgot. $1.60 something. Yeah. All right. So lastly, our free cash flow or discounted cash flow method. Okay. So this one is going to be our free cash flow, which we said was 5.5 times 4. So it was 22 million a quarter. So let me put that here. 22. This is million. Sorry, I got a lot of errors this video, huh? Perpetual growth rate, 4.7, so let's round down to 4, and then I'm going to discount at 15%. All right, so 230 divided by 8.9, because this 230 is my market cap, and I get a value of $26 a share. All right, so average price target of $28. That's my target price. That's really what I think it's worth right now, paying for it right now. So I think you're immediately getting a huge discount. Now let me show you something that's even more enticing. This is their 2024 goals, and this is something they've had posted for a while now, and it's pretty crazy. It's pretty ambitious. So they're saying by 2024, they're going to have $1 billion in revenue and $425 to $450 in earnings per share. And that logistics segment I just talked about is going to be bringing in $400 million of that $1 billion in revenue. All right, so watch this valuation, because I actually think this is a better way to value stocks, and it's very quick. and it's kind of a inverted way to think, but it's neat. All right, so you're going to say, let's say that it takes them a year longer than 2024 to get to their goals. So they're going to do it in 2025. And let's say they don't quite hit it. They get to $4. They don't get to $4.25. So in 2025, they're going to have earnings of $4 a share. With a PE of 10, which is pretty conservative in my opinion, if they had grown that fast, usually if a company grows like that, they got a big PE. But anyway, with a PE of 10, that would put them at a value of $40. So at $40 in 2025, all right, here's what you do. $40 in 2025, that's 3 years from now. So divided by the current share price, which I just said was 18, and then raise that to the 1/3. And what you say is that if you think that they're going to get to $4 a share in earnings by 2025, and you invest right now at $18 a share, with those assumptions, you're getting a 30% return on your money on a yearly basis, okay? So like, just to put that into perspective or to show you what I mean, $18 right now, first year goes up 1.3 times, next year goes up another 1.3 times, final year goes up another 1.3 times. That's the $40 in 3 years. It would take 3 years to get to 40 at a 30% return. That's why I'm buying the stock and loaded up even more today to make it by far my biggest position. Look, if you disagree with me, leave it in the comments. I know I had a bias coming into this. I mentioned it. Anyway, if you did learn something, please like and subscribe. I'll see you next time.